Hello and welcome to Mel on the Street. I'm your host, Mel Schaefer, and today we're speaking with Lloyd, wealth advisor and investment strategist at Strategic Wealth Partners. Thanks for joining us today, Luke.
Hey, Mel. Thanks for having me as always.
So I want to get started by talking about Fed Chair Jerome Powell, his comments at the Jackson Hole Symposium last week. And, he all but confirmed rate cuts are on the table for next month. What move do you think the central bank is going to make, and what's your outlook for the economy?
That's a loaded question, Mel. I love it, though. A question we always get, right? So look, at the end of the day, you have to remember why we're in this spot in the first place. For all the years before COVID of free money being printed and then COVID happened, we saw $9 trillion of deficit spending happening from the economy, and really inflation's an input from the government spending a lot of money. So now you have a situation to where the Federal Reserve was basically designed for two reasons: to bail things out when things go bad, and to break things when times are too good and inflationary pressures are too high. So what's happening right now is a lot of yellow flashing lights around these unemployment reports we saw. It's not necessarily the rate of unemployment at like 4.1% that's concerning. It's the rate of change of how quickly we went from 3.5% up to 4.1%. So where does it go from here, right? That's a big question. You're seeing credit card spending. You're seeing middle-class America kind of with their spending habits and consumer debt levels. They're taking now loans out to pay off credit cards, but they're not just paying off that debt with credit cards. They're actually taking more loans out, which means they're able to spend more money that they don't really have. So the Federal Reserve is now in a spot to where corporations are starting to think, what is the next step? What are the next things coming from an economic standpoint? And I think things are kind of breaking. So I think they're going to go for the full 25 basis point, not 50 basis points. But the question becomes not necessarily the 25 basis point or 50 basis points we get. The question becomes, what do they do after the first rate cut? And what happens typically in history is many more rate cuts come. And the market's pricing in nine rate cuts as we head into next year. And in my opinion, the only reason you get 9 rate cuts being priced into the market is if something bad happens, if a recession happens, right? So I think we're kind of at that edge between that recession starting to come.
Well, the investment and trading community will be watching closely to how the market behaves leading up into that event. Investors are also going to be watching very closely Nvidia's earnings after the closing bell today. What will the market see, and what's your outlook for the stock?
So Nvidia's been the arms dealer, right? Everyone knows that. They've been basically the only game in town when it comes to these artificial intelligence chips. So all that demand's got pulled forward, right? I think really, if you take a look at the future earnings and the growth rates it has, it's really not priced too expensive. The question becomes, can that growth rate continue? Can that growth of the stock continue? And in my eyes, a lot of those large corporations, those small businesses that order those chips that's in the backlogs, these iPhones. I don't upgrade my new phone every single year. It doesn't really get that much better. So I think it's kind of a similar thing where, a lot of these backlogs, once they get delivered, corporations aren't going to be looking to upgrade their chips every single year. So I think you're actually going to see some kind of talk around what their future growth projections look like if that demand is still going to continue, and the stock's price, like it's perfect. And I think that they're going to deliver on their earnings. They're going to do pretty well. But I think because it's priced for so much perfection, I wouldn't be surprised if you see a little bit of red on the screen after the earnings report. And if that's the case, if it gets below $100, we'd back up the truck and start buying some more. But at these levels right here, we're waiting for another 20%, 30% sell-off to add any more to our position.
So do you have any AI stock picks, maybe
Yes.
that aren't Nvidia?
Yeah, absolutely. So Salesforce has been a great winner. That's kind of a behind the scenes kind of AI play. You also have like the manufacturing automation revolution going on, to where you don't just have to look at the technology stocks to play AI. So Emerson Electric's like a manufacturing firm that's combining robotics and AI to help with this automation revolution that's coming. You're also seeing a lot more onshoring here in the U.S., which is going to benefit manufacturing here in the United States. So Emerson Electric is a position that we've added to and looked at adding. Also, behind the scenes too, you need energy to build out all this AI, right? 40% of U.S. energy is supplied by natural gas. So as we go through this transition to more energy consumption from AI, you need natural gas. So we've been adding natural gas to our portfolio through ETFs. You also want to look at nuclear energy. So uranium sold off pretty significantly the past couple of weeks. I think uranium, or Cameco Energy, that's the number one supplier of uranium. I think that they those are spots you want to take a look at. So you just don't have to play AI with technology. You can play it outside of technology in all these different areas.
If we can pivot now to some news out of Canada for a minute. On Monday, Prime Minister Justin Trudeau announced a 100% tariff on Chinese EVs. How might this news affect the sector and stocks such as NIO and XPeng? And do you think it will affect Tesla?
So this goes into a bigger story at play here, right? So anytime you have government getting involved in the free markets, they usually mess things up. I mean, that's just the simple fact of the matter is government's not the best at allocating money to and resources to pick the winners and losers in the free market. So I think this EV kind of sector in general, you saw Ford lose like $2 or $3 billion on their EV sector, which means they can't invest in other areas to allow the free markets to pick the winners and losers. So in general, whether it's tariffs or whether it's government subsidies for electric vehicles, I just don't think the market's ready to digest the average consumer who's already struggling to put food on their table or to fill up their gas tanks. They're not looking to buy the newest electric vehicle at this point. So I think the issue in general is a bigger issue at play. In electric vehicles, you don't want to play maybe the electric vehicle manufacturers. You want to play the technology within electric vehicles. So a stock that has been a rock star stock for us. We bought it like at $6. It's at $30 now. I wish you would have had me on like a year ago to talk about it. It's a little harder to talk about it when it's already 5x. But ASPN Aerogels, ticker ASPN, they make the gel that surrounds the batteries within electric vehicles. They're one of the biggest innovators within the electric vehicle sector with the technology side, not just pumping out vehicles. That's how we're playing it because, frankly, I don't know if Ford, GM, Stellantis, Tesla, I don't know who's going to come out ahead. I don't have a crystal ball around that, but what I do know is the technology is going to continue to be developed, and electric vehicles will be here to stay maybe 10 years down the road. But as it stands right now, there's too much unprofitability around the sector for those manufacturers pumping out electric vehicles.
So this kind of brings me to my next question. I was going to ask about small caps. The Russell 2000's up about 7% over 3 months, but the entire market has really been on fire. When do you see a larger rotation taking place into small caps, and what's going to be the catalyst for that?
Well, this comes into the conversation with the first question you asked me. What happens with rate cuts, right? Because rate cuts should technically be beneficial for the smaller companies that already have a lot of leverage and debt on their balance sheets. So these small companies, one thing I kind of alluded to is Federal Reserve is great at breaking things and bailing things out. So when you go through the breaking cycle, you have all these zombie companies, usually in the small cap space that are getting wiped out because you're looking at big lots of the world, or you're looking at these other bankruptcies. Small business bankruptcies are up 60% year over year. So I think we still have more breaking to do in certain parts of the small cap space because there's a lot of companies that really should never exist in the first place, but they existed because of free money. So I do think that you probably have a little bit of pain to go in the small cap space. But once we start the rate cutting cycle, maybe not the first rate cut or the second rate cut, kind of maybe midway through the rate cut cycle, I think small caps will be a really good place to be because then small caps turn to mid caps turn into large caps. That's the cycle of economic growth. The bigger question becomes what happens to unemployment and what happens to the overall recession. So as it stands right now, I would be looking at the small cap space in general, but I would be more maybe picky on what stocks I actually own, like regional banks. I wouldn't maybe own some regional banks because I think some defaults are still going to occur. Bankruptcies are still going to continue to occur. I think a large portion of the small cap space in the Russell 3000 is those regional banks. So you want to maybe steer away from those regional banks and look at more picky at certain areas that may benefit from the rate cut cycle and understand that stocks you own, whether or not they have good cash flow or not. Don't own those stocks with a lot of debt in their balance sheets because even if rate cuts do happen, they still have to finance that debt and they still have to pay off that debt.
And lastly, Luke, can you share 3 of your top stock picks?
It's a loaded question. So I think right now going forward, you want to pay attention again to maybe the financial sector at the top. So as the big get bigger and small get smaller, that's been the story for the past 4 years. We saw this flood of liquidity. We saw higher rates. And when you have companies with a lot of cash on the balance sheet, not debt on the balance sheet, they're the ones benefiting from this higher rates. Apple, for example, has a couple $100 billion earning 5% risk-free. I mean, they're making like $10 billion a year just on their cash because they have such a large cash pile. So from the banking financial sector, as I kind of alluded to, as things break, I think a lot of investors, a lot of retail people that have their accounts in certain banks, they're going to upgrade to those larger institutions. So look at the JP Morgans of the world. Look at the investment banks. As the big get bigger and small get smaller, you're going to want to look at M&A activity. So Lazard is a great stock that we've been owned for a while that's done very well. They're an M&A bank, mergers and acquisitions. They help facilitate those larger institutions buying smaller companies. So I think as things continue to break a little bit, Their small businesses will get acquired. They need an investment bank to facilitate these transactions. Lazard is another stock we'd be taking a look at, and we do own in our portfolios. In technology in general, instead of Nvidia, I think AMD, taking a step down into the AMDs of the world, that's kind of right behind Nvidia. Maybe not the top dog, but I think it's got some catching up to do. I think as Nvidia maybe sells off because of all the demand, or maybe finds a nice base, I think AMD is a stock I'd pick over Nvidia at this point, given the run up you saw in Nvidia.
Fantastic. Well, Luke, thank you so much for joining us. It's been a pleasure.
Thanks, Mel.